Hey everyone. Well, thank you for joining us today. Today's webinar is called New Year's Financial Resolutions, and it's from the perspective of an accountant, an estate planning attorney, and a financial advisor. Today's webinar will be presented by Yuri Yu, who is an accountant, CPA, and her office is located in Fullerton, California. Donna Lee is a certified financial planner and her office is located in the city of Orange. And I'm Sophia Kim Sakamoto, an estate planning and probate living trust attorney with offices in Buena Park and Mission Viejo. If you do have any questions, go ahead and type them in the chat box below and we'll see if we can answer them time permitting. At the end. And of course, this webinar is being recorded. Just a quick disclaimer. Of course, this is not don't take this as legal or tax advice. It's just general information. If you do have a specific question, either ask it here or we will, you can email us and we'll get back to you at the end of the presentation. Screenshots are discouraged. If you do need to have a copy of the presentation, check out our YouTube and express permission is required. All right, well, let's get started right away. Of course, New Year's resolution, and I hope your 2022 is going well so far. I'm sure everyone wants to know, what are the new tax laws? What should I do for tax planning? So Yuri, have you heard any news about taxes and anything new that will affect your 2021 and 2022 taxes?
So there haven't been really as many changes as we thought there were going to be. Since a year ago, I was talking about Biden's tax plan and all the things that were going to be included in it. And the House passed their version, I think in November or December, and then just radio silence. We don't really know what's going on. We know that there's going to be some changes to it. It's probably going to pass at some point. At this point, we don't really know. There's a good chance that there's going to be two big tax packages this year, one being Biden's tax plan, the other being another appropriations tax plan. I don't know if you remember, but that was kind of something that happened last year. So it's just going to be another year of a lot of tax changes. But luckily, fortunately, nothing passed last minute that would affect us retroactively. So I think we can cautiously move forward with our 2021 tax returns without any major changes happening at the last minute, like the last 2 years, which was very difficult. Yeah, but fingers crossed, you never know. Very exciting in the tax world right now.
Very exciting.
Yeah, so just to start, 2021 personal tax returns are due April 18th. That's a Monday. April 15th is actually a Friday, but it's a holiday in DC. And so just to make things extra fun, the personal tax deadline always, is adjusted a little bit, a day or two sometimes because of that. One thing that we definitely have to look out for, two big things that we'll have to look out for on our 2021 personal returns are the stimulus payment reconciliation and the advanced child tax credit reconciliation. So the third stimulus payment was IRS started issuing it in March 2021, and then they kind of like trickled payments throughout the year. So it was originally based on your 2020 tax return, but if they didn't have it on file yet, then they used your 2019. And then if you filed 2020 and your income was lower, then they gave you more. So you might have gotten it in one payment, you might have gotten it in two. There were a lot of random payments that the IRS issued in 2021. So it's really important that you have those records when you do your return, because it all gets reconciled on your 2021 tax return. Unlike the first and second stimulus payment, where if you were eligible for it and then you were able to get more, the IRS would automatically just give you the additional amount. They're not going to do that with the third one. So if you are able to get more, but they didn't give it to you, you have to report it correctly on your tax return. And if there's any discrepancy between what you received and what you filed and what the IRS thinks you got, it's going to cause delays in processing your returns. So same thing with the advanced child tax credit. IRS started issuing those payments monthly in July. You had the option to opt out, but both spouses had to opt out. So there were a lot of cases where only one spouse opted out, so then they got half payments. And I myself tried to opt out and then I couldn't. And then every month our payment amount was different. And so I was like, oh, it's gonna be really fun. So this is another thing where you want to make sure that you know exactly how much you received so you can claim it correctly on your return. Otherwise, it will cause delays in processing. IRS has been issuing a lot of notices in the past year, but it's also been really, really hard to get through to them. So it's like, we want to do whatever we can to prepare the 2021 tax return with the best information to avoid having to contact the IRS for, these kinds of things. So another thing is unemployment benefits. So in 2020, unemployment benefits were not taxable. That didn't carry over into 2021. So if you received unemployment benefits in 2021, it will be taxable on your federal return. California never taxed it, so it's not taxable on your California return. Also, something new that started in 2020 was that if you don't itemize, you could deduct $300 of charitable donations against your taxable income. This is in addition to your standard deduction. Last year, it was $300 whether you were single or married filing joint. In 2021, it's $300 if you're single, $600 if you're married filing joint. And then another big thing for 2021 is the California pass-through entity elective tax. This was passed sometime in July, and this is a SALT workaround is what they call it. SALT is the state and local income tax. I don't know if you remember, way back in 2018 with Trump's tax laws, they limited the amount of state and local tax that you could deduct on your return to $10,000. State and local income tax includes your property taxes and the amount of income tax you pay to other states. So if you're a California resident, then the amount of California tax that is assessed on your return. This hurt taxpayers in high property and income tax rate states, like us here in California and some East Coast states, New York, New Jersey, states like that. So a lot of states came up with their own laws as like a workaround. So if you have an entity, a pass-through entity, like an S corporation or a partnership or an LLC, something like that, the entity can pay the state income tax for you, deducts it on its return, you claim a credit for it on your personal return, and kind of works that way. It's kind of complicated. Each state's a little bit different, and California has been really slow on issuing guidance on this. But if you are part of a pass-through entity, this is something to kind of look out for. And it's possible you may want to extend your return to make sure you get the credit right, because there's going to be some math involved to make sure that you maximize it, because there's some tax rate issues and things like that. So those are the fun new things for 2021. For 2022, just looking forward, tax returns are going to be due April 17th, 2023, as far as we know. There's going to be more cryptocurrency reporting required by these virtual currency exchanges. I don't think we know exactly how that's going to work. More guidance is probably going to come, but just know that if you're heavily involved in the virtual currency area, you're probably going to start getting more tax forms. Of course, whether you get tax forms or not, the stuff is taxable, and the laws are they're very strict and they're a little bit complicated. So you want to make sure you report them correctly on your return. When it comes to, if you make a mistake on your return and the IRS catches it later, they'll assess penalties, and there is statutes of limitations on that. But if it's fraud and you are negligent and intentionally underreporting income, there is no statute of limitations. They can go back forever. So just keep that in mind, not to scare you or anything. I'm sure we're all very, law-abiding, tax-paying citizens here. So the other thing for 2022 is there's going to be increased 1099-K reporting. So this is designed to catch people who are, underreporting their income. Usually it was issued by to businesses by companies like PayPal or Stripe or Venmo. If you are a business and you are processing credit card transactions through them, then they would issue you a 1099-K if they process more than $20,000 in transactions, but they reduce that to $600. So it's a very small amount. I actually received a 1099-K information request from Ticketmaster because I sold some tickets, and I'm not a business, so I don't really know how this is going to work out, but just another thing to kind of keep in mind for this year. Some of the changes that we do expect from the Build Back Better tax plan, if and when it ever passes, are increased tax rates for wealthy people, an increase in the state and local income tax deduction that I talked about, an expanded net investment income tax. This is a 3.8% tax that is usually assessed just on investment income, but they want to expand what is included investment income. And they were supposed to start disallowing backdoor Roths, but we really don't know what's going to happen there. Donna, you haven't heard anything, right?
Not yet, and we're all just waiting. It's really hard to make planning decisions, especially for planners, right? Type A, we want to plan everything. It's really hard to do that if we're just sitting in limbo. So like you said, we're scared that they're going to come back and do something retroactive, right? And we're also scared that they're going to just say, okay, from this date forward, it's going to be different. And we just can't anticipate at this point.
Fun. Okay, so here's just some of the things that you should get together for when you are preparing your 2021 tax returns. Obviously, you want to have all your tax forms, W-2s, 1099s, 1098s. If you are using a tax preparer, make sure you give them the entire package. So even if your 1099 is like this thick and it's like 100 pages, I need all 100 pages, please. There's information in there that can affect your taxes. So if you omit it, usually it's to your favor too. So there could be numbers on those supplemental like information pages that would help. You don't want to forget about the Form 1099-G. This is if you received any unemployment income or paid family leave benefits. I don't know, for some reason, I think the envelope they send these in is a little like unclear. So a lot of people will lose it or just, gets thrown out with their junk mail. So this is something that you should be able to download from your online state disability account if you need it, if you can't find it. And if you received health insurance under the marketplace, like Covered California, you need your Form 1095-A for your returns. If you don't report on your return, the numbers from that form, you will get a notice and your return will get stuck in processing. If you purchase, sold, or refinance your property, a copy of your closing statement is also useful in preparing your returns. A lot of times there are additional deductions on there that's not reported to you elsewhere that you could take on your return. And these new letters from the IRS that they'll be issuing, they started sending them out this month, so I think most people should have received them already. The letter 6419, that reports to you the amount of your advanced child tax credit. Fun thing is that a lot of people are saying that the amount on the letters don't match what they received. So I heard of someone who called the IRS and the IRS agent told them, oh, you can't trust that letter. You should go with what you have in what you received in your account. So I am going to highly recommend that you create an IRS online account. You can do this directly from the IRS website. They'll verify your identity. And once you log in, you can see how much child tax payments you received, how much third stimulus payments you received. It's actually called the economic impact payment. So it'll be under that section. You can see history of your tax payments, estimated tax payments you made, things like that. So I'm probably going to encourage all of my clients to do that this year because I just don't want to get in a situation where there's any delays in processing your returns or your refunds because it is so hard to get through to the IRS right now. So those are the two letters to watch out for, letter 6419 and letter 6475.
Yuri, what's that website again? The IRS website?
Go to irs.gov and there should be a place somewhere where you can create an account to check your payments. And also you can look at your transcripts.
Awesome. Wow. Lots of information. Thanks, Yuri. But I know a lot of you are wondering also, what about retirement planning? What's new? Is there any other numbers that I need to know for this year? Donna, what are the limits for 2022?
Yeah, so they did increase the limits. Every year, the limits do change. This index to inflation, and inflation is a big thing right now. But they did increase the limits. So for 2022, the salary deferral limits for 401k, 403b, 457b, or your solo K is 20,500. The catch-up applies if you are 50 years old or older, and it still is the same at 6,500. Keep in mind that this is for the salary deferral. This is not the total amount that can go into your 401k. This does not include like your employer contributions or any profit sharing contributions. The limits for this year with regards to IRAs, traditional and or Roths, stays the same. It's $6,000 and it's $1,000 if you're 50 years or older. The limit applies only to contributions. I know a lot of you have heard me say this before, but I get this question asked all the time. It only applies to contributions. So if you're doing any type of transfers or rollovers, that does not eat away into your $6,000 or $7,000 of contributions. You have to have earned income to make contributions into any retirement account, not just IRAs or Roth IRAs. Same thing with like 401ks and solo Ks and such. Has to be earned income. So passive income, rental income, that does not apply. Need to make sure if your IRA, if you're making contributions into a traditional IRA, whether that's deductible or not, and that has to do with if you're an active participant in your 401k as well as income limits. And then the Roth IRA income phase outs have changed. They've gone up a little bit more. Again, this is indexed to inflation. So if you are married filing jointly and your anticipated, I guess, AGI is going to be under 204, then both of you will be able to contribute the full 6,000 into the Roth IRA. If you make over 204, this is modified AGI, so it's not gross income, but if it's over 214, then neither of you, husband nor wife, neither of you will be able to make any contribution at all. And if you make somewhere in between 204 and 214, then it phases out. It's a straight line reduction. So let's say you make half midpoint, let's say 209,000. Then both husband and wife can only do a max of 3,000 for the year, if that makes sense. So, but this is really important to keep track of. And so it's important that you're, whether you're using a CPA, URI, or a tax software to keep track of this.
Awesome. Well, you know, of course, one of the things that you should also be doing is estate planning. Of course, you know, what happens to your assets if something happens to you. Recently, I had a client who, you know, waited to literally like the last minute. And it was, why did they have to do that? If you're already in a situation where you become incapacitated or you're not here, it might be too late. So better to get this done now. This is the start of the year. I know it's been on your to-do list, so let's do it. Set up a living trust if you own real estate or you have minor children. What happens if parents pass? Where does the money go? You know, a 2-year-old can't manage things. It's best to set up a living trust so that you designate the next person who can manage things for them. Prepare your healthcare forms. My goodness, it's so important, especially nowadays. If you can't tell the doctor what to do, who's making this health decision for you? What if your whole family is disagreeing? Who's going to make that decision? And financial powers of attorney and guardians. Also check your beneficiaries on assets. I have a client where, you know, mom and dad died, kids came to me and they're like, okay, we're ready to sell the house. Well, guess what? The property was in uncle's name. So yeah, he got the property. So check your beneficiaries, check what's on the title of property, make sure to get that updated. If you have an existing estate plan, check your trustees and distributions. A lot of times clients come to me, their trust is like 20 years old. You know, back then their kids were little, they had, you know, their mom or somebody being the trustee or a guardian, but now they've passed on or they've gotten older, kids turned 18. So always check if, you know, when you have a life event, marriage, birth, death, disability, retirement, and see if you can get your trust and other estate planning documents updated. I say like every 3, 8, or 5 years is a good rule of thumb, and also check if the beneficiaries are correct. Also wanted to talk about just the new tax laws affecting estate planning and trusts for this year. Last year, the federal estate tax exclusion was $11.7 million. So this means if you passed and your gross assets are under 11.7, you didn't have to pay any estate taxes. Now they've raised it to 12,060,000. So for a married couple, that's like 24 million in assets. You don't really have to pay taxes if you have less than that. If it's over that amount, great, awesome, but it would be about a 40% tax rate on that. The annual gift exclusion. So this is the amount that you can give to people without having to file a gift tax return. Last year, 15,000, this year, 16,000 per person. So just a few things to keep in mind. Oh, also want to say that the federal estate tax exclusion, that 12 million that I was talking about, it's set to expire in 2026, unless, of course, Congress makes another change. So the year in review, 2021, a lot happened, was a crazy year. I don't know about you, but especially in my line of work, I noticed there was quite a bit of deaths that occurred last year, unfortunately. And if that happens, you know, does it go through probate court? Did they have a trust? Should a trust administration be handled? Also keeping in mind, you know, are you filing the right property tax statements with the county? There is some statutes that are running, some time periods from the date of death. So if you haven't already, you should talk with either a CPA or an attorney to figure out, so you don't miss any of those deadlines. Property taxes might get reassessed. When there's a death, there's a change in ownership in real property. Of course, you know, you may have heard that, oh, if it goes from a parent to child, the property taxes should stay the same. Remember, last year, Prop 19 passed. So there are some changes in the rules about that. And you also want to think, was there an addition to the family? Was there like a birth? Was there, did you get married? Did you purchase a new home? You know, real estate prices have been going so crazy. A lot of people getting new homes. Put that in a living trust if you haven't. Did you start a business? I know Yuri and I were talking about it. She was mentioning that a lot of our clients are starting new businesses, like a side hustle. If that happens, you know, that's also part of your estate. That has value. You own that. So consider estate planning for that and talk with a CPA.
Yeah, definitely. Right. If you are thinking about starting a business, talk to an accountant before, especially before you like just go and start, you know, creating LLCs and corporations, all of that kind of stuff. You want to make sure you fully understand the responsibilities that you immediately are in charge of as soon as you incorporate or start an entity, especially in California. There are a lot of rules and they will find you.
That's true. And if you already have an existing living trust, sometimes you as the trustee could be the owner of this corporation or LLC. So that's also something you want to explore and see if that's right for you.
And then one thing I also mentioned is that estate planning is governed by the state that you are a resident of. So if you recently moved and you moved into California or out of California and you have a living trust, it is worthwhile to get that reviewed by an attorney in that state, because sometimes there are little nuances that can be different.
That's a good point, Donna. I get that question all the time. People who've moved like in and out. And usually the trust will say, you know, these terms are governed by the laws of the state of, you know, California, where we used to live. And so you do need to get that updated. I was talking to someone yesterday and they're like, oh, they live in North Carolina, but they have property in California. It's best to make an estate plan where you live. You can put assets that are in other states in your California trust so that they're all kind of managed by this trust where you live. But yeah, those are particular questions that you definitely need to talk with an attorney about.
And yeah, some states are better than others when it comes to estate planning. Like certain states are super easy and some are super hard. California is definitely one of the harder ones.
Well, that's what I've heard. That's what I've heard. The probate process in different states much easier, but California, of course, as with everything, it's very just rigorous and there's a lot of things that you have to follow, laws and things that you need to be aware of.
Yeah, same thing applies to like corporations or LLCs, especially with so many people working virtually or remotely. You know, maybe you started in California and then now you move to, I don't know, Florida or somewhere in the middle, I don't know. So you want to make sure that your LLCs and corporations are properly registered. And also, if you are in California, I know there's a lot of people out there that will just create, LLCs or corporations in like Delaware or Wisconsin. You just want to make sure you really know why you're doing that. It's really probably a good idea to consult with a business attorney to discuss with them whether there are really any benefits for you before you just, start creating entities like that. Because once you get in a state or an area or whatever, it takes work to get out.
Very true.
All right, well, Donna, I know that there also life insurance is something that's very important, and sometimes you push it off to the back burner, but it's also important to do that as part of your New Year's resolution.
Yeah, life insurance is one of those areas. It's second behind setting up an estate plan, I would say, where clients just seem to want to just procrastinate and not think about it and just kind of defer it every single year. But the beginning of the year is a great time to kind of realign and refocus your efforts on those things that it's been kind of nagging you. So life insurance, just some background, some basic information about what it is and how it works. It is a legally binding contract. So a lot of times I hear like, oh, well, is it possible that I buy this policy and then it never pays out? The short answer is no. It is a legally binding contract. It is enforceable by each state's Department of Insurance. There are a lot of M&A action in the insurance world where certain insurance companies get bought out by another, a small one gets bought out by another, or maybe two large ones merge together to become even bigger. So what happens to those contracts? As you can imagine, if anytime there's going to be a company that does not honor their contract, any contractual obligation, it is going to look bad for the entire industry. So whenever there is a merger or an acquisition and someone buys out the contracts, all of those contracts are basically completely enforced by the new carrier. So that should not happen. The policies, as long as it's active and the death occurs, it is guaranteed to pay out as long as there's a death, with the exception of three things. One, illegal activity at time of death. So if you were robbing a bank and the cops shoot you and you pass away, I don't think it'll pass out. They don't pass out the death benefit then. Act of war, if you get sent to war, or suicide within the first 2 years. Any of those three, those are exceptions, and the life insurance companies will not pay those out. There is a 2-year contestability clause. So what that means is if on the application you say, oh, I'm not a smoker, and yet you did, and then they catch you, they can only catch you basically within that first 2 years. And then after that, you're free and clear, I guess. But those are some basics of life insurance.
Donna, have you noticed any changes in premiums or anything because of the COVID and the pandemic and things like that?
No, I have not, interestingly enough. I think it's because it's been very recent. Interestingly, a couple of years ago, well, maybe no, it's more than a couple of years ago, the mortality tables were actually changed. People were living longer, and because the mortality tables changed, premiums actually went down. But that's obviously tracked over a much longer period of time. So, that's a good question. I have not seen that. I don't expect that to happen unless this is going on for, I don't know, a decade or something like that.
Okay. Well, what about life insurance for dependents? I'm sure you get this question all the time. What's the difference between term and permanent life?
Yeah, that's another big question I always get. So the difference between term life and permanent life, think about term life as like car insurance, right? You pay your car insurance whether or not you get into a car accident. If you do, your car insurance is there to cover you. If you don't get into a car accident, you still pay your premiums, right? It's kind of wasted premiums. It's a pay as you go kind of a life insurance kind of thing. It is the best bang for your buck though. It covers a fixed length of time. Usually it's in intervals of 10 years, 20 years, or 30 years. I have not seen them longer than 30 years. And there's a certain amount of premium that's agreed upon. So it's a contract, right? So the insurance company basically says, okay, I will give you 30 years of this policy for this amount of dollars, and you pay that. If you decide, halfway through, I don't want this policy anymore, you don't have to continue paying it. You're not locked into paying the entire term. However, once that term ends, let's say you did a 10-year term and now you're in that 11th year, you still can keep the policy, but the price can be dramatically different. And I have literally seen them they go up like 10 times all of a sudden. So it really doesn't make sense to keep those policies once the term expires, unless there's like a pending death and you really need it, or there's some health issues and you just have to have that policy. It makes a lot more sense at that time to cancel the policy and get a new one, as long as you're insurable. Permanent life insurance is a little bit different. Permanent life insurance, think of it as like, it's like buying a house, I guess is a good analogy. It can last a lifetime. The premiums that you pay is not just pure life insurance. It's life insurance premiums plus a savings component. There's a savings component part to the premiums that you're paying every single month or year. And that savings component gets saved for you internally in the insurance product. This cash value, it can be invested in a variety of ways. It can be invested in like CD-like investments, certain guaranteed instruments, and usually those are called universal life, fixed universal life. It can be invested in stocks, bonds, mutual funds. Those are usually called variable universal life. It can be invested in index funds, and it can be called indexed universal life. So there's a whole bunch of terminology for it, but it's all based on how that savings component is being invested. There's a lot of moving parts to a permanent life insurance policy. You can imagine that with that savings component, depending on how well that savings component does, if it does really well, maybe you can stop paying early. If it does really well, maybe you can even start taking money out of the policy. If it doesn't do well, maybe you have to put more money than you expected into the policy. So there's a lot of moving parts involved with a permanent life insurance plan. If the purpose is purely just to cover for dependents, you have young children at home and you just want to make sure that they're taken care of in the event of something that happens, then term life is probably the best bang for your buck. Permanent life insurance is a great vehicle for solving certain specific problems. When a lot of times we use them in estate planning issues, when there's a death that happens and we need to have a certain dollar amount get paid out. It doesn't matter when that death happens, it just has to be there when the death happens. So in that case, we're left with permanent life insurance. But basically there's pros and cons for both, and it just really depends on what you're buying it for, what the purpose is.
Yeah, definitely. If you do have minor children, life insurance is something to protect them, because parents don't realize that when they pass, they're losing that income source. So who's paying the mortgage, right? So having life insurance is definitely important. And speaking of dependents, I'm sure you get this a lot too. What can parents do if they want to save for college for their children?
So there's a variety of different ways that you can save for college for your child. Really, it comes down to 4 different options. There's something called a 529. It's specifically designed for higher education. There's a Coverdell Education Savings Account. It's designed for education. And then there's a trust account, UTMA or UGMA. It's not necessarily designed for education. It's just money for your child. It could be for college. It could be for shoes. It could be for a car. It could be for anything, as long as it's money for the child. And then the last option is just a normal taxable account. I save money in my own name. And then when my kid goes to college, I just pay their tuition out of that account. There's a lot of different little nuances with each type of account, and I have broken it down into the next couple of slides, but really I'm just going to focus on the 529 one for now, just because that's the main one that most people use for education. From a tax standpoint, 529s work similarly to a Roth IRA. It is funded with post-tax dollars. You do not get a deduction. There are some 529s that will allow a state tax deduction, but the state of California is not one of those states that allow it. So basically, as residents of California, every plan is fair game. So it's funded with post-tax dollars. It grows tax deferred. And when you take the money out for education purposes, as long as it's a qualified withdrawal, it is tax-free as well. So it kind of works like a Roth IRA. The money is in your name as the parent. The title of the account is parent name for the benefit of child's name. So the money is actually in the parent's name. So what that means is you're the owner. You can change your mind at any time. You can say, you know what, this kid doesn't need money for college because there's a giant inheritance for college and they don't need this money, right? Whatever it is, you can change your mind and take that money out and go, you can buy a car, you can buy a boat with that money. You can do that at any time. Also, because you're the owner on the account, not the child, it also will look differently on financial aid purposes, for financial aid purposes. So when you fill out FAFSAs, they do take a look at the income and assets of the parent and of the child. So because the 529 is in the parent's name, it's no different. It's looked at no differently than if you had money sitting in a taxable account in your name as the parent, or in your bank account in your name as the parent. Whereas if you had the money in the child's name, like in a trust account, the UTMA or UGMA accounts, it's looked upon as if it is the child's money. And it's going to be, when they do the equation and factor in all the different factors, it's going to be factored in very heavily. Let's see if I'm just going to scroll through this real quickly to see if there's anything in particular we can talk about. 529 is a good estate tax tool as well. Sophia had mentioned earlier that the annual exclusion this year is $16,000 a year that you can gift someone without paying gift tax. So for grandparents that have a lot of grandchildren and they're trying to do some estate planning, they could actually gift 5 years in advance. So that means they can put $80,000 a year, not a year, I'm sorry, $80,000 all at once into a grandchild's account. If it's grandma and grandpa, that's $160,000. If they have multiple grandkids, you can imagine the effect on estate planning, how much it can cut down on their gross estate when they do this. There's no income limitations for making contributions into the 529 account. Anybody can make contributions. I have clients that open up 529 accounts. They save monthly in there. And then I noticed during Christmas, maybe birthdays, red envelope money, you know, there's extra lump sums and they can always deposit those lump sums in as well. Grandparents can deposit in directly if they would like. Anybody can contribute on behalf of the child. There's a lot of more information on here, as you can see. So this is going to be recorded and will be on YouTube in the next week or so. So you're welcome to come back and look at the chart a little bit more in detail.
Yeah, that was very interesting, Donna. A lot of things to consider when saving for college. I know there's a lot of options too. Yuri, I know that you get these questions. What are some IRS red flags, things to be aware of?
Red flags. So these are things that may not necessarily get you audited because the IRS does not do as many audits as they used to, but it could get you a tax notice, which is really just a really big pain right now. So a big thing, automatic thing, is if there's a discrepancy between what is reported to the IRS and what you report on your tax return. So that's why it's very important to have copies of your W-2s, 1099s, 1098s, any tax document that you receive, and also the stimulus payment and the advanced child tax credit. You want to make sure that what you report on your tax return matches what the IRS has in their records. Otherwise, it is an automatic computer-generated notice and it will hold up your return. If you don't file a tax return at all, that could trigger a notice, especially if they have tax documents on file for you. So that's another thing to keep in mind. I did interestingly have one case where a taxpayer was retired. They didn't have any taxable income, but they had a mortgage in their name. So they received a Form 1098 from their lender, and they got a notice from California that said, hey, you have a mortgage. You must make money to pay that mortgage. Where's your tax return? Do you have any income? And we had to like write a letter and explain to them that they didn't. So just something to kind of keep in mind. Tax payments that are made online under the spouse's name, for whatever reason, the IRS system cannot match those payments to the primary taxpayer's account. And so that tax payment will go into the spouse's account. The tax return is filed under the primary taxpayer's account, and there's no matching. So what happens is you'll have to call or write a letter to get someone to manually apply that payment to the correct account. So hopefully this is something they will fix soon, but it is a big issue because so many people are making payments electronically. And if you do have a tax payment to make, do make it electronically. They still have trucks full of mail that they have not processed yet. So anything that can be done electronically is better. Excessive deductions or credits. So a lot of the things that are reported on your return, you will receive a tax form for, W-2, 1099s, mortgage interest, things like that. But there are some deductions or credits for which you don't receive anything. So like charitable deductions, your property taxes, things like that. If you are taking an excessive deduction, you could get a notice asking for proof of that deduction. We don't know how the IRS comes up with that amount. They have their own algorithms. They'll say this taxpayer makes this much money, but their donations were higher than average for someone in that area, for someone with that kind of income. And so this could trigger maybe not an audit, but it could trigger an audit as well, or just a notice where they ask you for more information. This will happen especially in areas like donations. So, you make $100, but you claim $50,000 in donations. That's kind of excessive. That's 50% of your income that you're giving away. IRS might have some questions about that. Also, non-cash donations, that is like a very red flaggy area. If you're claiming high non-cash donations, it's a big area of abuse. So just make sure that you have really, really, really good records if you're claiming non-cash donations. Just having a Schedule C increases your chances of audits. This is if you have a sole proprietorship or a side gig or anything like that. Major red flags are if you have expenses but zero income, so no revenue and like just expenses. If you have losses over several years, the IRS might think, hey, is this really a business? Are you in this to make money, or is this just a hobby and you're just trying to write off your expenses? So you have $100 in income and $10,000 in expenses. That doesn't really look good as well. And just these areas where things get blurry between people's personal and business life. So auto expenses, entertainment expenses, meals, travel, home office. As long as they're legitimate, do take them, but make sure you have good records so that if you ever are questioned, you can just give it to them and it's no change. And the last thing is deducting a large rental loss. Rental loss by nature is considered a passive activity by the IRS. There's a lot of rules on deducting losses, but if you're a real estate professional, you are allowed to take much larger losses than like your average taxpayer. But the rules to be classified as a real estate professional are very strict and very specific. So if you are going to take a large rental loss and you are claiming to be a real estate professional, make sure you work through their requirements, and you really are. Otherwise, it's just, it could also attract some attention there as well.
Well, thanks for letting us know all these potential things that might trigger a notice or audit. We do not have any questions, but if you do have any questions that you want to ask, feel free to email us. Here's our information.
Yeah, I love how we always end just on time. We try to action pack this 45 minutes. So thank you very much, everyone, for your time. We really strive to provide content that's worthy of your time, as you can see. And we hope that you find these webinars useful. So we know that our presentations contain a lot of information, especially like that chart that I was referring to earlier. So the recording is made available on the website, usually by the end of the following week. So by the end of next week, it should be on there. Our next event is going to be on Friday, February 18th at 12 o'clock. We will have a family attorney as our guest speaker. He commonly gets questions regarding how to title property, community versus separate property, what to do before you get married, what to do before you get divorced, prenups, postnups, all these types of questions. Perhaps you have some questions yourself. So if you do, please feel free to email us and we will try to have him answer it then as well. But he's basically going to be talking about those and answering some frequently asked questions. You will be receiving a survey shortly, so please respond so that we know what kind of improvements we can make, or what other topics you'd like to hear, or what other guest speakers you think would be helpful. We hope everyone stays safe and healthy until we can meet again next month, guys. Very, very good to have you guys with us, and we'll see you soon.